Hey, I get a lot of questions about ETFs and options and all kinds of good stuff. I have different buckets that I use to generate income in different ways, whether it's be options or distributions from ETFs, just growth stocks or growth ETFs that are just sitting there and growing until we may need them someday. So I want to share 8 of my favorite ETFs that I'm using to generate monthly income that will probably be forever ETFs. In other words, these are ETFs that I don't see myself selling, only adding to in the future. And let's take a look at that right now. So these are the 8. We have QQQI, TDAC, SPY-I, GPIQ, KQQQ, T-SPY, QDVO, and GPIX. And I have them in the percent that I own in my portfolio. Now, this is mixed in with my growth ETFs like SPY, SPY, and QQQ, and VTI. So this is the percent of my overall retirement portfolio, but it doesn't include cash holdings. And I'll show you that in a second here. So let's look at Blossom. So Blossom is like a social network app for financial things, personal finance. And I've been a member of this for a while now and just started actively using it in the past 6 months or so to see what other people are doing and compare notes and some different things. And you can tie your brokerage account to it so you can see what other people are investing in. And what it does a reality check. So when you see an influencer on YouTube saying retire on $100,000 investment in this ETF or that ETF, but they don't actually do that themselves. They're telling you what you could do, but they're not doing it themselves. So I like to show what I'm doing myself because I don't like these pie in the sky scenarios when people don't actually do this stuff. I like seeing what people are actually doing. What I share, I would say, I don't know if I 100% of the time, but 99% of the time, it's what I'm actually doing. It's real money. So you can see the percentages of what I have. Let's click on all stocks or ETFs. So we have a lot of money in cash right now because I'm kind of thinking there's going to be a pullback in the market. We got maybe upwards to 25% of our money kind of just sitting in our brokerage account and still getting like 3.5% interest for the time being. Yeah, I just got a feeling. So sometimes I go by technical analysis and all this other cool stuff. And other times you just get like a gut feeling. That's what I'm getting right now. I thought the market would run up before Christmas and then level off here at the beginning of the year, and I think it'll dip down a little bit. And then as it gets closer to interest rate cuts, probably in April, I think the market might go sideways or down a little bit for a while, and then it go back up. Now, what I'm saying is just my gut feeling. It's not based on anything except for what I think. So let's get back to my favorite ETFs. There's 8 favorite income ETFs. I want to say income ETFs because my favorite ETFs are probably QQQ and SPY, which is actually my biggest holdings. And typically SPY is at 35% or so. But like I said, we sold some and got some cash sitting around. And another growth is SPMO. And I won't talk about those because those aren't what we're here to talk about. What I'm here to talk about is the first one is QQQI. And just to jump back here, these are the ones we're going to talk about, these right here. So getting back to the ETFs here. This is tied to Blossom, and I want to show this because I want people to see that I really have money in these and how much. So 7.7%. So my Excel spreadsheet's a little bit off because I prepared that a week ago and I changed some things and things pay distributions and things are constantly changing, but this is close. So QQQI, 7.7%. And then the next one is SPY-I, which is 4.4% of my total. And then GPIQ, 3.9%. And then also another favorite is TDAC, 3.4%. And let's go down here and look for another one. Another one here is QDVO, that's on my list, and 1.3%. That's the percent of QDVO I have in my entire portfolio, not counting cash holdings. Another favorite is KQQQ, that's Curve Technology. T-SPY, 1.1%, and then GPIX, 1%. So those are the 8. So these 8 are what I consider my buy and hold forever at this moment. Things are subject to change. Income ETFs. So these are the monthly amounts that they pay, and the total is $3,600 per month approximately. And these are the dates that I pulled the information from. I was going to do this video a couple of weeks ago, so I pulled this information a while back, and since then I've gotten updated distributions from a couple of these, but they're still very close and very similar. So about $3,600 each month. So quickly, I want to go through these and tell you why they're my favorite. And we'll start with QQQI and SPY-I, and we're going to kind of lump some of these together because QQQI and SPY-I, they belong to the same company, and that's NEOS, NEOS. So let's jump up here to a web browser. So here's the NEOS funds here. So I'm at the NEOS website for QQQI, and you can see some things right off the bat. Pays monthly, distribution rate is 14%. And if you scroll down, you can read some more information about it, like how long it's been in business. It's been in business almost 2 years now, so it has a bit of a track record. And I'm not going to bring up SPY-I, but SPY-I has been around a little bit longer. It pays about 11-12% monthly, same type of expense ratio and all that good stuff. So I have a combination of these in taxable accounts and also IRAs. So in taxable accounts, these distributions, I'm trying to manage my taxable income at this point in my life. I'm converting money from my IRA to my Roth IRA, and I'm trying to do that in such a strategic manner that I don't want to get clobbered too hard with taxes. So it's important to keep a close eye on income at this point in my life. Try not to pay more than my fair share of taxes. I'm very American, but I just want to not pay more than my fair share, let's say. So there's a thing called return of capital, and I'll bring this up. So this is the 19A1 notice for QQQI. And what's telling me here, if I look down here, percent of current distribution column here, and it says estimated return of capital. And it says 99%. And if you look at the total for the year, it's estimating 100% estimated return of capital. So I'm not a tax expert, but I'll tell you what that means to me. When you invest this money, let's say I put 10,000 into QQQI, they pay that monthly distribution of 14%. So let's say over a year's time, I get $1,400. When I get my tax statement from QQQI, it will say $1,400 of that is return of capital. Basically, it means they're returning my money to me that I've already paid taxes on. So this is like a non-IRA. This is a brokerage account that's taxable. It says they're returning my money back to me that I've already paid taxes on. I don't have to pay taxes on it again. Not yet, at least. When that $1,400 a year gets to the point where it equals the 10,000, my investment, at that point, my distributions will be taxed at long-term capital gains, which is still a lot less in my situation than ordinary income. Sounds a little bit complicated, maybe, maybe not. But the point is that for the next couple years, my returns on QQQI and SPY-I will be mostly return of capital. There might be some that's ordinary income, and these are estimates right here. But a year ago, it was almost completely return of capital. So I didn't have to pay tax on this yet because it's my money they're returning to me at this point. Another favorite fund is GPIQ and GPIX. And we'll just look at one of these since they're the same company, Goldman Sachs, which is quite a legitimate company. I think most people have heard of Goldman Sachs. So if you scroll down, you see some different information, such as expense ratio, which is quite low actually for this type of product. You see how $10,000 will have grown over time. You can look at the yearly returns, all kinds of good stuff. And down here, you can see the distribution rate is like not quite 10%. But when I get through these, I'm going to go back and we're going to look at total returns and all of these and compare because there's something I want to look at. So Goldman Sachs is the same thing as far as the return of capital. Here you can see they list both. This is the GPIQ. This one here is the GPIX. And they have those listed up here so you can see that I'm not lying to you. But same thing, return of capital, and these two are 96% and 89%. So once again, these are great for my taxable accounts because I don't want to pay taxes at the moment. I want to pay taxes later at long-term capital gain rates, and that's what works for me. Now, if you hold any of these in an IRA, a Roth, or traditional IRA, it doesn't matter because the taxes is what it is when you withdraw the money. It doesn't matter if it's return of capital or anything else. But it doesn't mean that these are not good for taxable or IRAs. I'm not saying it's better for one or the other, but some of these are definitely better for taxable accounts than other funds that don't treat this as return of capital. So another one of my favorite funds is TDAC and also T-SPY. So TDAC is relatively new, but T-SPY has been around for over a year. And it's not just that I like the results so far. When you actually read the prospectus and listen to the founder of the company, Tap Alpha, talk, it explains exactly what they're doing, and you do your own little bit of research, I am convinced that they have something good going on with this, and I like their strategy. So some people say, well, these QQQI, GPIQ, TDAC, KQQQ, they're all based on QQQ. And why not just dump all my money into QQQI and call it a day? Well, I could, and they're very similar results, but they each approach things a little bit differently. And my thought is I just want to diversify. So if one of their strategies starts not working quite as well, the rest of them will kind of level that out and I can adjust later. But for now, all their strategies seem to be working pretty decently. And if one starts to fail a little bit, I will maybe shift money out of that into some of the others or find another one that might work. So moving on, the distribution rate of this one is 17%, which is actually quite good. And in my opinion, when you start hitting 17%, as far as cover call type ETFs, that's about the maximum I feel that a company could probably generate on a consistent basis without the NAV declining. So there's definitely ETFs that claim they can do better than that, but then the NAV is declining. So you start out with 10,000, 6 months later you might have 9,000. You're still earning 17%. Now you're earning 17% on 9,000 and not 10,000. I want the NAV to stay at least steady or grow a little bit, and that's one of my requirements for these buy and hold forever ETFs. I want the NAV to stay at least steady or grow. And here in a few minutes, I'm going to look at a total return of all these compared to each other. Tap Alpha is another one that has the return of capital. And when you go to the websites, you look for something that says either tax information, more documents, or something. You look for the 19A1 form, and you can pop that up and you can look to see where it says return of capital. If it says 100% or 90%, that's kind of what you want to see. So the next one we want to look at is Curve, KQQQ, distribution rate 17%. So they're relatively new. And once again, if you listen to the CEO or the founder of Curve, he really stresses preserving the NAV, protecting that. So in other words, their goal is not to give you a nice big fat juicy monthly return and have it eat away at the NAV at the same time. So if I invest 10,000 today, I can be somewhat assured that in a year's time, that should also be worth 10,000 or more in a year's time. Now, if the stock market in general declines, then that 10,000 is going to decline with the stock market. Let's say the S&P increases 5%, I expect that NAV to increase about 5%. But the whole time, I'm also expecting the 17% return as a distribution. So does it work out exactly like that for every fund, every month, year to year? Probably not, but that's what I'm hoping for. And once again, there's the 19A1 notice, and you can look at this, and it looks like estimated return of capital, 97%, and for the year, it looks like it's 96%. So that fits my requirement. And then, so this kind of goes for T-SPY and TDAC, two of my favorites. The last one is QDevo. It's a little bit different. This doesn't really like the other funds, and the monthly distribution is a little lower when you look at it. It's like 10%. However, the overall return is equivalent to the rest. And we're going to look at that in a minute, I promise. And once again, if I look at the return of capital, 19A1 notice. So for the current distribution, it's 96% return of capital. And then for the calendar year to date, so this is November 28th, 2025, so this is 11 months, they're estimating 98% return of capital. Now you get the true return of capital when you get your tax forms from each of these companies. And I'll repeat once again, for those funds that I'm holding in taxable accounts, this is one of my requirements. It has to have a big chunk be return of capital because I'm trying to defer taxes for a couple of years while I convert some of my IRA money into Roth IRA money. Okay, now let's look at something. This is a website called totalreturns.com, and you can plug in different tickers from different ETFs or stocks to compare things. So I have my 8 favorite ETFs for my income generating ETFs, I should say, but I also put in SPY and QQQ to compare. So this is year-to-date return. Now, some of these numbers are skewed a little bit because, for example, down here at the bottom, TDAC is relatively new, and these results are only from September of 2025. So there's only like 3 or 4 months worth of data. Once again, some people might say, why are you investing in a ETF? How can it be your favorite when it's only out for 3 months? Well, it's the sister fund of T-SPY, which has been out for quite a bit longer and has shown really good results. It uses the same strategy to generate the income, except this is based on the QQQ instead of SPY, SPY. So TDAC, everything being equal, should perform a little bit better. So I'm trusting that the fund managers are going to do an equivalent type of job that they've done for T-SPY. But anyhow, so let's keep moving on. Well, year-to-date return for SPY, QQQ, almost 16% here and 19% here. So QQQI is about 17%. So now this is total return. This is the increase in the NAV and the distribution. If I jump back, you can see the distribution was 14%. However, the total return is almost 3% more than that. So that's something I look for. I look for total return and not just the distribution. You go to a lot of ETF websites and it'll show 34% distribution or whatever, but you need to look at the total return to make sure your NAV is not disappearing on you. SPY is 14% total return. Now the SPY wasn't going to make this any longer than what I don't make this too long, but if I go to SPY I here, you can see almost 12%. So total return, 14.5%. So the NAV is increasing along with those distributions. GPIQ, 17, almost 18% total return. I think the distribution for that is only like 10%. GPIX, total return, 14%. The distribution for this is right around 10, 8 to 10, I believe. SPY, 15.5%. KQQQ, 15%. If you remember though, the distribution is like 17%. So that NAV has declined a little bit. However, I have faith in their strategy and think the NAV will recover and things will be fine going forward, but I'll keep an eye on this one. Well, 17.83% total return. And if you remember that one, it was about 11% returns. Not only is that NAV increasing, it's increasing at a pretty good rate, actually. And then TDAC is hard to compare because it's only been out since September. So this is a 3-month return for TDAC. If you remember TDAC, the distribution rate was 17%, but the total return for 12 months is almost 11%. So this is only a 3-month sample size. But I expect this to be kind of a consistent 17, 18% going forward, with most of that being the distribution, but I expect the NAV to grow maybe 1 to 3% per year, which is something I'm fine with. So I'll wrap it up here. I might do more of an in-depth look at each of these in separate videos, but this is 8 of my favorite income ETFs that I actually own myself and what I consider my core ETFs for income that I plan on keeping forever. So this video is a little bit different than the other videos I put out, but if you want to see some more videos that show some of the ETFs that I actually buy myself and why I buy them and not back testing fake numbers, these are real things, let me know because I don't mind sharing what I own and why I own certain things. So if you made it this far through the video, I appreciate you watching and be sure to subscribe and give it a like if you enjoy this type of thing.